In the financial world, knowledge is power. And when it comes to options trading, understanding option Greeks is a key part of that power. These Greek symbols, namely delta, gamma, theta, vega, and rho, are crucial in measuring risk and predicting how changes in the market could affect option prices. Each symbol represents a different aspect of market behavior, and together they provide a comprehensive insight into the complex dynamics of options trading. Stick around as we delve into the world of option Greeks, your secret weapon in options trading. First up, we have delta, the most frequently used and arguably the most important Greek. Delta essentially measures the sensitivity of an options price in relation to changes in the price of the underlying asset. Picture it as a percentage that represents the likelihood of an option reaching in-the-money status by expiration. For example, if an option has a delta of 50%, it means there's a 50% chance that the option will end up in the money. It's interesting to note that delta values range from 0 to 1 for call options and -1 to 0 for put options. Delta also helps traders anticipate how much an option's price will change for every $1 move in the underlying asset. So if a call option has a delta of 0.6, we can expect the option's price to increase by 60 cents if the underlying asset's price increases by $1. With delta, you can predict how much an option's price will change with a $1 move in the underlying asset. Next in line is gamma, the first derivative of delta. Now, what does that mean? Imagine you're driving a car. Delta is your speed, how fast you're going. But gamma is your acceleration, how quickly you're speeding up or slowing down. In the world of options trading, gamma measures the rate of change in delta for each $1 change in the price of the underlying asset. In simpler terms, it's the sensitivity of the delta in response to price changes in an underlying asset. Think of an option contract as a sports car. The delta tells you how fast the car's speed, or option price, will change with the movement of the underlying asset. But the gamma tells you how quickly this speed is accelerating. It's like the turbo boost in our sports car analogy. So gamma is critical in predicting the future movements of delta. It's the pulse of the volatility. Gamma tells us how much the delta will change with a $1 move in the underlying asset. It's the acceleration of the option's price. Let's move on to theta and vega, two Greeks that every trader needs to understand. Theta, often referred to as the time decay of options, represents the rate of change between the option price and time. It's a measure of the rate at which the price of an option is expected to decrease for each day that passes. Now let's turn our attention to vega. This Greek isn't quite as well known as delta or gamma, but it's just as important. Vega measures the risk of changes in implied volatility. It tells us how much the price of an option is expected to change for every 1% change in implied volatility. So if you're trading options, it's important to keep an eye on both theta and vega. They'll help you understand how time and volatility could impact your options prices. Theta represents the rate of change between the option price and time, while vega quantifies risk from changes in implied volatility. Finally, we have rho, the Greek that measures sensitivity to the interest rate. Rho is often overlooked, but it's an essential tool for understanding how changes in interest rates can affect the price of an option. Let's break it down. Rho represents the expected change in an option's price for a 1% change in interest rates. For instance, if an option has a rho of 0.05, the option's price would increase by 5 cents for every 1% rise in interest rates. However, rho is more relevant to long-term options since short-term options are less sensitive to interest rate changes. Why? Because the longer the time until an option's expiration, the more it can be affected by a change in interest rates. In a nutshell, rho allows traders to assess the risk associated with changes in interest rates. So, the next time you're evaluating an option, remember to factor in rho. Rho helps traders understand how changes in interest rates can affect an option's price. So there you have it, a concise yet comprehensive guide to option Greeks. We've demystified delta, gamma, theta, vega, and rho, explaining their roles in the fascinating world of options trading. With these tools in your arsenal, you're better equipped to navigate the market's ebbs and flows. Understanding option Greeks is pivotal in options trading. Subscribe to our channel for more insightful content on finance and trading. Remember, in the world of finance, knowledge is power. Empower yourself.